Some people just aren't emotionally built to own stocks. And that's usually because they don't understand what they're really buying. You're not just buying a stock symbol, you're buying a piece of a real business. No one gets that better than Warren Buffett. As of June 2025, Warren Buffett's investment track record remains extraordinary. Since taking control of Berkshire Hathaway in 1965, the company's stock has delivered a total return of approximately 5,502,284%, equating to an average annual gain of 19.9%. In comparison, the S&P 500 has returned about 39,054% over the same period. Buffett didn't achieve this by chasing hype. He followed a simple, powerful strategy. His longtime partner Charlie Munger once summed it up perfectly. Only invest in businesses you truly understand. Look for companies with a strong, lasting competitive advantage. Choose leaders with integrity and talent, and most importantly, never overpay. Always leave a margin of safety. This approach never changes, not in 1984, not in 2025, because real investing wisdom isn't trendy, it's timeless. Now let's be real. In 2025, investors have some extra challenges on their plate. Stock markets are trading at sky-high valuations, interest rates are elevated, and inflation is still hovering around 3%. The Fed is trying to rein it in, but the pressure is real. So how do we invest in a market like this? That's what this video is all about. We're going to use Warren Buffett's timeless advice, applied to today's unique environment. Let's start with the big one, overvalued markets. What do you do when everything seems expensive? If you're an active investor, the truth is, opportunities might be rare this year. Finding undervalued businesses within your circle of competence could take time, but that doesn't mean you should chase what's trending. It means you stay patient, focused, and ready, because real value still exists. You just have to wait for it. Warren Buffett said it best back in 2019 in his annual letter to shareholders. He wrote, "In the years ahead, we hope to move much of our excess liquidity into businesses that Berkshire will permanently own. The immediate prospects for that, however, are not good. Prices are sky high for businesses possessing decent long-term prospects." Now sure, Buffett's talking about buying entire companies, while most of us are just buying a few shares. But the principle is exactly the same. And here's the key. Even one of the greatest investors in history has struggled to find good opportunities in an overpriced market. But does he panic buy expensive stocks? Not a chance. That's Buffett's cardinal sin, overpaying. Instead, he does what few investors have the discipline to do. He stacks cash and waits. That's why Berkshire Hathaway is now sitting on a jaw-dropping $350 billion cash pile. Patience isn't just a virtue, it's a strategy. Buffett has said, "You don't need dozens of amazing investments to win big. 3 wonderful businesses is more than you need in this life to do very well." It's why he is content to sit on all of that money and wait for the right pitch. That was Buffett's advice for active stock pickers. But now, let's talk about what most people should actually do when it comes to investing. Now, for most people, Buffett actually recommends a totally different approach, passive investing. And guess what? It still works, especially in 2025. As Buffett says, the best thing you can do? Buy an index fund and never look at a headline again. Treat it like a farm. You don't check it every day, you let it grow. Here's the jaw dropper. If you had put just $10,000 into an S&P 500 index fund in 1960 and reinvested all your dividends, you'd have over $4.9 million today. That's the magic of staying in the game, letting time and compounding do the heavy lifting. For the passive investor, it isn't about trying to invest at the perfect times. The nature of the dollar-cost averaging strategy is that you continue to buy market-tracking investments at the same time intervals, rain, hail, or shine. And by doing this over decades and decades, you will get the average return of the market. And by the way, it's about 8 to 10% per year. And this isn't just my opinion. This is straight from Warren Buffett himself. Here's what he said. You should do it over a period of time because the very nature of index funds is that you're saying, I think America's business is going to do well over a long period of time, but I don't know enough to pick the winners, and I don't know enough to pick the winning times. Buffett even admits, occasionally I think I know enough to pick a winner, but not very often. and I certainly can't pick winners by going down the list and saying this one's good, that one's not. So if Warren Buffett, one of the greatest investors of all time, says he can't time the market or pick all the winners, what chance do the rest of us have? That's why he recommends a simple, steady approach, buying low-cost index funds over time and letting American business do the heavy lifting. So the important thing to do if you have an overall feeling that business is a reasonable place to have your money over a long period of time is to invest over a long period of time and not make any bet implicitly by putting a big chunk in at a given time. Stick to your plan. Think ultra long term, and the stock market becomes your greatest ally. Even if you invested everything today and the market crashed 50% tomorrow, that's not a disaster. Not if you're in it for the long haul. Remember the 2008 financial crisis? One of the worst crashes in history. And yet, investors who stayed the course were back to even in just 5.5 years. Fast forward 9 years, and the market had nearly tripled. So yes, stocks might look expensive right now. But if you're investing for decades, that's just noise. Now back to active investors. You need to stay patient and not do anything silly. And for passive investors, you need to continue on as we always have. Just keep gunning for that average. Now let's talk about interest rates. They are like gravity for the stock market. That's not a metaphor. That's Warren Buffett's actual words. Back in 2021, when rates were near zero, Buffett explained it like this: if gravity pulls less, you can jump higher. And if interest rates drop, asset prices float up. Fast forward to 2025, and gravity just got a whole lot heavier. The Fed's benchmark rate? Over 4%. Even short-term treasury bills are yielding more than 4%. That's a big shift. Now, money managers don't need to chase risky stocks to earn a return. Bonds are finally paying again, and that changes everything. It puts pressure on stock prices. It makes the market more cautious. Take, for example, Nvidia, which has soared to incredible highs. Despite its undeniable innovation and market leadership, the stock's valuation already reflects substantial future growth. In a high-interest rate environment, investors might demand a higher rate of return and become more cautious about paying a premium for growth stocks, even ones as powerful as Nvidia. The key question isn't how exciting the stock is. It's how much you're paying compared to its actual, realistically achievable growth rate in this economic climate. And it brings us back to Buffett's point. When interest rates rise, valuations fall. That's just how the math works. So what do smart investors do now? They don't panic. They don't chase hype. They wait for real value, and they pounce when it shows up. Think of a company like Amazon, which has come down considerably and has the power to keep growing even if the economy doesn't. The question is, how much are you paying? That's the Buffett way, and it works in any interest rate environment. So, what does it really take to win in the 2025 market? It's simple, but not easy. If you're an active investor, remember, patience isn't just a virtue, it's your edge. Don't chase overpriced stocks. Do what Warren Buffett does. Sit on cash, wait for your pitch, and swing when the value is real. If you're a passive investor, your job is even simpler. Keep dollar cost averaging. Stick to index funds, and tune out the noise. Because time in the market always beats timing the market. Whether you're picking a few great businesses or buying the whole market, the rules haven't changed. But sticking to them, that's what separates good investors from great ones. If this video helped shift your mindset, even a little, hit that subscribe button. This channel's all about timeless investing wisdom that actually works, especially in markets like 2025.